Welcome back, everybody, to Energy Central's Power Perspectives. I'm Kinsey Grant Baker. We talk a whole heck of a lot on this show about prices. They're going up, as most of us know, pretty much across the country. This year, electricity prices were up about 6.7% in the US, and the EIA projected a 13% increase in nominal average electricity prices from 2022 to 2025. It's mostly the usual suspects that are to blame: increasing demand from data centers, electrification, aging infrastructure, hotter temps leading to more power usage, et cetera, et cetera, et cetera. But when we talk about prices, we can't have a full conversation without talking about where it all starts: capacity markets. The forward auctions that seek to ensure there's enough power plant capacity on the system to meet projected load. Lately, capacity markets have become a very hot topic, and that's in part because of what we saw this summer. Capacity prices in PJM's latest auction hit a $329.17 per megawatt day price cap across its region, up 22% from a year ago for most of PJM's territory. PJM, the largest power grid operator in the United States, said the increase to record high capacity prices could lead to bill increases to the tune of 1.5% to 5% for some ratepayers. So, what does this mean? Is this the norm now? Is reform ever coming? And in a utility industry appropriately obsessed with how customers perceive their services, what do sky-high capacity auction prices mean for the future of keeping customers happy and prioritizing affordability in that three-legged stool of reliable, resilient, and affordable power systems we're always thinking about? We've got really, truly the best in the biz here to walk us through it. Christoph Graf is a senior economist at the Institute for Policy Integrity at NYU School of Law, whose work focuses on energy and climate policy with a sharp eye on electricity markets and the mechanics of the energy transition. We met Christoph through Amy Myers-Jaffe, a former Power Perspectives guest whose insights continue to feel prophetic. So I know this conversation is about to be really great. Christoph, welcome to Power Perspectives. How are you today?
I'm doing well. Thank you so much for having me, Kinsey. I look forward to the conversation.
Me too. And, as I mentioned in this introduction, there's a lot to unpack here today. There's a lot to talk about. And I want to start by making sure that we're crystal clear on the basics. So, could you start by giving us the sort of 101 level on capacity markets, what they are, what they aren't, why we have them in the US?
Yeah, I'm happy to. So, if you allow me to zoom out just a little bit, I want to talk about first. I mean, I will talk about about capacity markets, but before that, I want to talk about something called the reliability externality and what that actually means. So, before we had restructured the market, so we go back in time for a little bit, we still live in the world with the single utility, basically vertically integrated geographic monopoly. So this utility was responsible for ensuring enough energy to cover demand in all foreseeable system conditions, demand and supply, in its service territory. And if something goes wrong, you go to your utility, say, well, that was your job, you messed up. That's what why. Another point is, a perfectly reliable system is usually comes at a price tag that nobody would want to pay. So when we talk about reliability, we always say sort of reliable, but it doesn't mean that nothing ever gonna break. So it is reliable, but not perfectly reliable, because that would mean you have to basically duplicate all the infrastructure to make sure that it is always there for you. However, in the restructured markets, we move to wholesale market regimes. So we have load serving entities who procure energy from the markets. And now we have no single entity anymore that is to blame or that is responsible for making sure there is enough energy all the time on the system. So the reliability of a household's electricity supply, like your or mine electricity supply, is kind of decoupled from my or your choice of the load serving entity, because we are in this grid together. And if it breaks for one, it breaks for everyone. That is what's called the reliability externality, which means what we have done in all the wholesale markets in the US, we have required them to have some kind of long-term reliability mechanism. And the capacity market is one way of doing it. There are other mechanisms. For example, in California, we have what is called contracting requirements. So we basically tell the load serving entities they have to make sure that they have enough generation contracted. So they go out, write long-term contracts with generation, and their responsibility is to just have enough to serve a load. Another model is what we have in Texas, which is so-called scarcity pricing model, which is like an energy-only market, the only energy-only market in the country, where we don't really have a separate reliability mechanism. We just have where the possibility of real-time energy prices able to go very, very high. That means it accounts for reliability in a way that investors who make like forward-looking investment decisions, they can count on that there are certain times in the year or in 5 years where the price will spike and they will recover the investment costs. However, I have to say after Winter Storm Uri, also Texas has like more political pressure to like move a little bit away from this energy only market framework. So that was like a little bit of a maybe too long introduction, but I think it's important to understand why do we have capacity markets or any other form of reliability mechanisms to begin with.
Yeah, it's really important and helpful context because I think it illustrates a theme that we have come across a lot on the show, which is, no two markets are the same, no two customers are the same, no two utilities are the same. When we're talking about PJM specifically, though, this is, as I mentioned, the largest in the country, home to a lot of really important parts of its territory, not the least of which being this concentration of data centers in Northern Virginia. When we look at the recent PJM capacity auction from over the summer that I mentioned in the introduction that got a lot of attention, it wasn't all for good reasons. The total cost of this year's auction climbed to $16.1 billion. So, can you just contextualize that a little bit for our listeners? What does that kind of headline really mean about prices in PJM, the cost of generated power, or even just the broader directions in which the electricity markets in the US are headed? What can we really get from that headline beyond just this is a big number?
It's a good question. So let me answer like in two ways. One part of the answer is when people talk about prices, then often, as you were saying, this is like a scary number. It seems like very, very high, and it seems higher than it used to be in the past. That's kind of the obvious kind of statement. Everybody can make that. The more interesting question to me is how would like have a different system where we had a different reliability mechanism or no reliability mechanism, how would that have performed in terms of total energy costs? Because as a consumer, I don't really care if it's like capacity prices or energy prices or some other prices. I care about the sum, right? So to me, the interesting question is what is like the real counterfactual, and I would want to compare it to that. So I'm not, like just like oh, price has increased by whatever percentage is I think not enough to like have like a really like deep analysis. The other thing, what I think is a little bit of a misconception with pricing is most of the people in the industry know that a lot can happen to prices. There are geopolitical issues, there are uncertainties everywhere, load can grow or drop. There's a lot of things that can happen, and that's why people usually hedge. So they, write long-term contracts, bilateral contracts, supply and demand, and they are the price at the spot market for either energy but also for capacity is then a little bit less scary because only a small part of their real capacity is affected by the price because they are hedged with like 80% of their other capacity. It's often less scary than it seems because often these auctions are thought of as kind of a residual market where people just like buy the little extra thingy that they haven't had like the long-term contracts for.
I think it repositions a lot of, my understanding of what these markets are and how they function with that answer because, to your point, this is not necessarily the like doom and gloom, fear-mongering kind of headline that we might interpret it as in the utility industry. One of the things that I think is really interesting about PJM specifically, in addition to what you've mentioned here, that it's not necessarily all doom and gloom and the fear mongering headlines that we read about. There has been a lot of specific actions taken with regard to price at these capacity auctions within PJM specifically. In January, PJM agreed to a cap on the capacity price for its next two auctions after the governor of Pennsylvania, Josh Shapiro, filed a complaint with FERC. This price cap and this price floor impacted this most recent capacity auction. I think the final price was close to that cap, if not right at the cap. And I understand there was even some pushback on the proposal of this quote unquote price collar to begin with. I'm curious to hear your perspective on just how this operates, this price collar within PJM, and what it means for prices at these auctions as we move forward into the next capacity auction coming up here.
Yeah, so you're right. We Governor Shapiro interfered. We have now for the next couple auctions a price floor and a ceiling. That means the clearing prices cannot exceed the price cap, and they cannot be lower than the price floor. What is, I think, important to realize is that all the demand for reliability is an administrative construct, right? So it's not. It is typically something that the system operators are designing administratively. Also, the original demand curve for reliability had a price cap, just like a higher one that has been also like designed through a stakeholder process. That Governor Shapiro thought it should be like a lower um, cap. And I think the argument was that if we are in an environment where we cannot build supply or not build supply fast enough, it's kind of unfair to let people like pay this high price, because the market then does not a lot to you, because it signals scarcity. But if you cannot resolve it, that is kind of perceived to be unfair, I guess. However, what it also does is it could end up in situations where you overprocure reliability, or you underprocure reliability, because the new kind of demand curve is capped and floored. So it has consequences on prices, but it also has consequences on the reliability that you're buying for those prices.
In the absence of this price collar, I'm curious what that looks like. You mentioned that demand for reliability is an administrative construct, which I think is a really interesting way of putting it. If there were no price cap, would prices have just gone through the roof because we are having all these conversations about demand for reliability? What might the auction have looked like without the ceiling and the floor that we had in this most recent auction at PJM?
I'm not sure how transparent the auction outcome is, so I'm
Mhm.
not. I don't know the answer to that, but it would have been higher. That's what I've been reading. Prices would not have gone to infinity, because there also was a price cap to begin with. So there
Mhm.
could have been another like maximum price per definition. But I think it's important to keep in mind that um, that the demand for reliability is a construct that some experts and together with stakeholder participation that they come up with, that this is a good representation. And there are many parameters to tune and to change, and there is a lot of controversy about all of that.
So in my inbox this morning, the morning that we are recording this conversation, there was a report from PJM's Market Monitor that said that data center load growth drove up revenue in the last capacity auction for PJM by $7.3 billion, or 82%, to a total of $16.1 billion. The quote from the Market Monitor was, quote, "Data center load growth is the primary reason for recent and expected capacity market conditions, including total forecast load growth, the tight supply and demand balance, and high prices." End quote. So if demand is, in fact a construct, how does the influx of data centers, this larger conversation about the impact of data centers on demand in general, how does that change the construct? Does it change the construct at all? Or are we going to kind of continue in this cycle? There will always be something to drive up demand. Or does this feel like a unique moment in time with this sudden spike in capacity need to power these data centers, especially in PJM, home to Data Center Alley?
It's real, right? So the data center demand grows projection is kind of wild. I want to point out that it is a projection. It's supposed to be growing, but nobody knows exactly by how much. But it's factored in and will impact the supply demand imbalance, and it will impact also the prices for reliability. Demand side is one part of the story, but also the supply side. We have siting issues. We have retirements were on the rise now with shifted policy. Maybe some of the retirements are taking back. So it's it's the whole system between supply and demand. So and those things change moving forward. So we are, as you were saying in the beginning, this is like a 3-year kind of out market. So we are relying also on predictions. And I think what is new is kind of, if you think about load growth or demand growth in the past, it's usually like organically, right? So it's growing like a little bit, 1% year over year. It's like a slow pace kind of, which is kind of in line with the electric industry, which is not a fast industry at all, right? It's like everything is kind of slow because there's a lot of red tape everywhere. And I think this is kind of clashing with the AI and data center and computing world, which you know more operates more on the move fast, break things kind of logic. So I think that is kind of new, that all of a sudden there is like this innovation, this data center people really value speed to market because this is a highly competitive space, right? So and the winner probably takes a lot of the gains. And so there is kind of this clash between this like slow electric industry and this fast data center that would quadruple the infrastructure within short amount of time. And we have not yet figured out how to do that. There are a couple of, I think, interesting ideas where, for example, the data centers should like bring their own generation and kind of they might be able to do it at their speed, or maybe we should say we are changing the way we are interconnecting load. So maybe they can have not a guarantee to get energy supply 24/7. Maybe we just curtail them every now and then they're like easier to integrate. So there are like a lot of new ideas how to deal with this new situation. But for now, it's having an impact on the whole industry. I mean, we're all like discussing about data center all the time now.
Yeah. I feel like it is the dominant factor in every conversation that we have on this show. And I almost feel like I say the words too so many times they lose their meaning, but I'm curious with that, that perspective in mind, that this is inherently a difficult task to famously difficult to predict the future, especially when you're squaring the very slow and methodical utility industry with the very fast and quick innovation of the tech industry. Do you feel like those two things are at odds in a way that is, not ever going to be solved? Is this a market that is inherently flawed? Is there a better way for all of this to work? You mentioned, data centers bringing their own load, but when we're talking about the PJMs of the world specifically, do you feel like there is a better path that is not the one that we are on right now, in the way that these auctions operate, the way that pricing is determined, the way that predictive, strategy is brought to bear? What would be better if there is a better path?
Most of the data centers and the conversations I had with some of the people was they want to be good grid citizens, right? Because they also know that we are in this grid kind of together. If it breaks for one, it breaks for everyone. So they don't want to be the culprit of like things going wrong. And I think they also care to a certain extent about affordability, because if the Americans are unhappy with their bills and everybody's blaming the data centers, I'm not seeing that this is a winning strategy for that. So I would hope that they will, constructively work on solutions. I think one way to contribute, for example, for the data center industry, would be to provide better demand forecast. And I understand this is a time where probably you want to exaggerate a little bit your demand forecast because that's the way to get money and you want to be very optimistic about the future. But in terms of planning the electric grid, that's not always the best thing because you need to plan for those forecasts. And also with the capacity markets, it's kind of the same thing because they use projections. And if it's very hard to project the future, you end up with like very high capacity market prices. So I think anything that could help the capacity market designer to get better and more realistic forecasts um, would help. I think the data centers bringing their own load would help too in many ways. And I think on the supply side, what would help is interconnection queues, siting, transmission. So there's a lot of things that would just allow that we can build more and more things more rapidly that would kind of help to resolve this like fundamental kind of problem with supply demand mismatch. Another thing is high prices are bad for consumers, but they are also good maybe for innovation on the electric industry side. So for example, if you think about demand side resources in forms of like pooling them to a virtual power plant, we've been talking about that for a very long time. There's still not as much happening as I, for example, would like to see. And they have typically a hard time in capacity markets because in capacity markets, it prioritizes resources that you can where you can kind of estimate the contribution to reliability. If now my EV, not that I have one, but if I had one, or my smart cooling or heating is pooled with your smart cooling and heating, and with any other people in the neighborhood, and we like have a virtual power plant, and some aggregator is like turning this into a product and like participates in the markets for energy, but also for capacity. It's very difficult to assess what would be the reliability contribution of that. First, there's no history of data. We don't, it never has happened before, so we don't know how it will perform. And so that creates a challenge because resource accreditation for reliability is a big deal because that's the number that transform the megawatt of supply capacity into like reliable supply. So if you have a utility scale solar installation, say like in the southern US, say like in Florida, and assume also that the reliability risk in that area is most elevated, say in the summer, in the hot summer at noon. So the reliability contribution of this additional solar in that area is high because you can expect that it will produce at peak capacity at exactly the time when you need it. But it's getting complicated because as you like scale the amount of solar, the reliability contribution of that technology decreases because you kind of by like adding this capacity, you're reducing the reliability risk in that period and shift it probably to another period. But it also not only the own resource, but also the interaction with other resources. Say like you add a battery storage now to the system. This would probably increase the reliability value of the solar again. So there's like a lot of complexities. And currently, the system operators are kind of figuring out what is the contribution of each technology to reliability, which involves like serious modeling exercise, because you have to look into like all the interactions between resources, but also the resource mix itself is not static; it changes over time, and so you have to account for that too. And so we kind of figured it out how to do it with renewables through this, what is called ELCC, effective load carrying capability. Renewable resources, it was kind of easier at a time where we thought correlated outages is not a thing. But we realized recently during the winter storms that a dispatchable resource, like say like a gas combined cycle turbine, the risk of break that this combined cycle gas turbine breaks is not independent from another combined cycle gas turbine breaking in the same neighborhood, it can be correlated with extreme weather. So, for example, we have seen like gas freezes. So the problem was that both units didn't get gas at the time where they needed it. So that was like called like a correlated risk or a correlated outage. And so the contribution also from this like easy to accredit technologies is also harder to quantify in times of extreme weather and in times of electric gas coordination. So there are like a lot of puzzles, a lot of modeling, especially with like new technologies. Like I was saying, the virtual power plant is not so clear how to do that. And so those technologies are um, a little bit at a disadvantage because they are not like physical things where we have measurements from the past or where we can easily like accredit them. So, and I think with higher capacity market prices, to come back to your original question, those resources or those technologies will get a better shot because people will start to think more creatively how to integrate them because all of a sudden, everything counts. We need just everything, and there's value in those things.
A lot of what you have just explained, I think, illustrates that again, we come back to this point of complexity, that this is a lot of proverbial moving parts that we're trying to orchestrate in one cohesive way to ensure that the power stays on. There is a clear end goal. It's just a very winding path to get there. Most of this conversation, I think, up until the last couple minutes, has focused on the system operators, the RTOs, PJM. When you're speaking directly to utility professionals who might have a say in demand response efforts or VPPs or licensing certain technologies, what is the message to utility professionals about their role in refining or revising or revisiting the structure of capacity markets as they exist today? Is there a role specifically for utility professionals who are more on the infrastructure and T&D side of things?
I believe so. So one thing I was mentioning before is hedging, right? So I think the thing with hedging is when prices are like not moving a lot over a long stretch of time, say like 5, 10 years, people kind of forget about that this is an important thing. So, and I think now the higher prices are kind of a reminder that a lot of things can happen in energy markets, and hedging I think is more on top of mind of also of utilities to make sure that they are not fully exposed to those prices. I think another form of hedge, and I've been hearing utilities talking about this more, is like owning or operating physical capacity. So there are some states where this is not possible. So utilities are not allowed to own and operate generation. But I've seen more and more saying, well, maybe that we should like invest in like our own generation because that's a physical hedge. Because if prices are high, I can just like generate myself. So I think the topic about hedging, but also the topic about like as we were saying, the virtual power plants and the making sure that we use all the possible things to bring on just any kind of capacity will help to address this issue and will help to address affordability, which is also on top of everybody's mind these days.
Yeah, absolutely. I mean, it's resiliency, reliability, affordability are the three words we hear every single day. It's an interesting way to finish out this conversation, to think about what the future could potentially look like. We have another capacity auction coming up here in no time, it seems. So it's good timing to have this conversation, Christoph. I really appreciate you sharing all this insight with our listeners. And if you will indulge me, I would love to do a quick lightning round with you if you are down.
Oh yeah, absolutely. Let's go.
Okay, so the goal here is super quick, short answers. We're gonna hit a couple of fun ones here. First question I have for you, Christoph: what do you feel most people don't realize or appreciate about the work that you do?
I was giving that advice in academia to basically learn one method very, very well and then make real world problems fit to the method. And I'm doing things the exact opposite way. I always focus on the problem first and then find like tools for it that would solve the real problem. And sometimes this means creating new tools, which is more time consuming, more painful, but I think is worth it in the long term.
Okay. I like that. Next one, if you had the power to make one single industry reform, no questions asked, what would it be?
This is a blanket answer. I would prefer less, but better regulation. I'm not a big fan of the current kind of band-aid approach that is kind of panic-driven, where we look at problems in isolation and have reactively fixing things. I would like a regime where we have less regulation, but they're more thought out and like work more generally.
Quality over quantity. I like it. Okay. And the last question I have for you, what is something that you like to nerd out on outside of capacity markets, outside of your job?
I love computational problems. So I'm super excited of a lot of the recent breakthroughs in computation. So when I think about my own kind of research models and what, moving, for example, from CPU to GPU based computation where you can like massively parallelize your software, this is things that keep me exciting. And I think I really want to use also this like new data center and AI kind of momentum to have like better research and better regulation.
That's wonderful. Christoph, thank you so much. Thank you for joining me today on Power Perspectives and sharing, all of this really wonderful and helpful context. As I mentioned, it's a timely conversation as we, head into the last little stretch of 2025. And I certainly learned a lot. I think a lot of the assumptions that I had about capacity markets and auctions have been flipped or at least challenged, which is always a wonderful outcome of these conversations. So I really appreciate you taking the time. Thank you so much for joining me today.
Thank you so much, Kinsey. It was a pleasure.
And thank you to all of you for listening, as well as a reminder, as always, you've heard me say it before, but we cover lots of headlines about PJM and capacity auctions and prices and affordability and reliability and resilience and all of that good stuff in the Energy Central daily newsletter. If you want to get the top headlines in energy news delivered straight to your inbox for free every weekday, Monday through Friday, you can find a sign up link in the show notes. Thank you again for listening, and I will see you next time.